Good morning, everyone. Welcome to the 8th episode of the Capital League Insight series. The topic for today's discussion is India Inc.'s earnings recovery. The Indian economy has bounced back steadily over the last few months. The Nomura Business Resumption Index crossed 100 last week, indicating that for the first time we have surpassed pre-COVID levels. It had touched a low of 60 in end of May this year when the second wave was at its peak. So once the severity of the second wave mellowed down, stock markets were quick to catch up with the booming global markets in the last 3 months. Global markets are up more than 30% since the pre-pandemic levels of March 2020, and Indian markets are up nearly 25%. Sensex has crossed a new high of 55,000. The question I'm sure on top of everybody's mind is, are we in bubble territory and are the markets expensive? Well, we've all been told that in the long run, stock prices are slaves of earnings. In the short run, of course, there could be other factors like liquidity, policy announcements, inflation, movement in interest rates, which can take the markets up or down. Hence, the answer to the above question lies in the fundamentals and the sustainability of the earnings and earnings growth. Corporate earnings are cyclical and they have been going through a trough during the last nearly more than 10 years. So if you look at earnings as a percentage of nominal GDP, then the earnings of top 200 listed companies were at 4.9% of nominal GDP at the peak of March 2008 and subsequently declined to sub 4, sub 3% levels since then, touching a low of 2.3% in March 20. So when we talk of valuations, the numerator is price and the denominator is earnings. Hence, if denominator, that is earnings, are suppressed, then valuations obviously look expensive. Given the above background, let us discuss the nuances of corporate India earnings growth, the factors affecting it, and its impact on markets. I would like to welcome Manish Gunwani, Chief Investment Officer at Nippon Mutual Fund. Manish is an industry veteran with over 20 years of experience and an ace fund manager with a stellar track record. Thank you for joining us today, Manish.
Thanks, Rajul, and thanks everyone for sparing your time.
Not at all. So welcome to this discussion on India Inc.'s earnings recovery. Before we start the discussion, I would like to mention that we shall have a 10-minute Q&A session towards the end. Request you all to please type in your questions in the Q&A section at the bottom of your screens and address it to the panelists. So Manish, let's start with the global economy. It has bounced back faster than anticipated on the back of robust stimulus packages. I mean, they're never ending, and rapid rate of vaccination, especially in the US and the Europe, which constitute nearly 80% of the global market cap. So I would like you to share some key factors responsible for this unprecedented growth and how is the stimulus different this time compared to the one provided during the global financial crisis in 2008?
Well, Rajul, I think it's very clear that we are living in a time of almost unprecedented economic theory, unprecedented stimulus. So if you see, for example, and just compare it to the great financial crisis, which we saw about 10, 12 years back, the level of stimulus is actually an order of magnitude above that. So in the financial crisis, US at peak had fiscal deficit of 10%. We are seeing 15% plus for more than a year. So almost 2 years, I think the US will have maybe around 15% plus kind of fiscal deficit. If you see Japan, and this is a very striking fact, that almost 48% of the bonds issued by the Japanese government are today sitting on the balance sheet of the Japanese central bank. So they've got so much bonds as part of that quantitative easing. So a lot of times people become very cynical about this, but I actually feel that this is not a bad policy. I do think that in a crisis like COVID, which is a once in 100-year kind of crisis, whatever it takes to recover economic output is okay, as long as two things don't happen. One is inflation doesn't go out of control. And to be fair to all the policymakers, when they gave this unprecedented kind of stimulus, there were a lot of cynics who believed that, gold will go to $5,000 and inflation will go berserk, hyperinflation will come. But that hasn't happened. And two is that it should have a real impact on the global economy. So if you see, again, comparing it to the financial crisis, so global GDP typically grows at 2.5%, 3%. So when the crisis happened in 2008, and if you were to draw a trend line, the global GDP returned to that trend line in almost 3 years, right?
Okay.
In this case, we have returned it to that trend line in third quarter of this calendar year, which is basically this quarter, which is about 15 months from the crisis. So whatever said and done, you can, wonder at what these central banks are doing. But the simple point is both in terms of growth and inflation, and those are the only two variables that matter for an economy. It has worked. So the good part is the returns, what we are seeing in this graph, have happened because the outcome has been good on both growth and inflation. So I'm not so perturbed about a lot of these fiscal deficit numbers, a lot of this quantitative easing. I think all these policies, as long as macro stability is there, and as long as they are in tune with the economy. So I think if the economy grows fast, and you're seeing Fed already do it, right? That they are talking of pulling back the stimulus. So as long as we keep it in tune with global growth, I think we should be fine.
Okay. So you think that this global growth will continue and one should not be unduly perturbed because, typically it does so happen that people wonder if Fed were to pull back or increase interest rates, then what will happen to our emerging economies also, right? I mean, on the chart, we saw that Indian markets performed in line with emerging markets, more or less, and April to June quarter, it was slightly lower because we had a second wave here. But in the last 1 month, we've actually outperformed the emerging markets by a wide margin. So at a fundamental level, as far as India is concerned, let's say, I mean, we haven't had that strong a stimulus package. And last few months, again, FI numbers have not necessarily been positive. So what is responsible for the bounce back in the economy? Are we seeing demand coming back? And what do you make of the tremendous pain in the unorganized segment? I mean, we see it all around us. So first demonetization, then GST, and now the pandemic. So could you give us a sense of what is happening on the ground?
Sure. So on the ground, obviously, as things are opening up, the high frequency indicator, one of them you mentioned in your opening remarks about the business resumption index. But if you look at the mobility indicators of Google and Apple, if you look at port data, you look at railway data, you look at electricity growth, all those kind of frequent indicators we look at, I think things are obviously going in the right direction. I think growth is coming back. If you see direct tax and GST collections also, they're quite healthy. So to my mind, Rajul, I've been on the buy side now for almost 11 years. And honestly, I think that this is probably the best macro India's ever been in. And I tell you why. Basically, simply put, economic growth has 4 components, which is consumption, private consumption, second is private investment, third is government spending, and fourth is exports. Largely, if you remember the economic textbook, C plus G plus I plus X, which is basically these 4, right? Now, if you think of each of these items, I think next 1 to 2 years, they should do very well because first is private consumption. Now, all of us have been locked at home. We've not traveled. We've not consumed movies. We've not consumed apparel. So clearly, at least in the top 15, 20% of India, which I think has a very strong balance sheet. Now, clearly, there is a lot of stress in the lower half of the society. But most of the stocks we buy trade in goods which cater to top 15-20%, right? Because it's urban, it's discretionary.
Mhm.
So the private consumption has a huge pent-up demand, and as malls open up, as airlines open up, we obviously will consume a lot of that. There are a lot of marriages, temple tourism, which are big in India, which also I think that activity will pick up. If you see private investment, it's been down for 7-8 years. I don't think anything bad can happen. Only good can happen here, because you have now capacity utilization going up in a lot of industries like cement, auto, and they will need to put up capex. You have this huge manufacturing shift where chemicals are expanding, electronic manufacturing is expanding, and a lot of PLI will help get new segments in. In terms of the third part, which is government spending, I think thankfully, even the Indian government has not, just to reduce fiscal deficit, clamped down on spending. They've kept overall spending at 10-12%, which I think is a good policy. And finally, and what you're already seeing on the ground is exports. Now, um, as I said, I've been on the buy side for about 10-11 years. And when I came onto the buy side, India's monthly exports used to be 25 billion plus or minus 3 billion. So I've seen India exports for 10 years stay flat at 22 to 28 billion. Now, after 10 years, you're seeing some traction that if you see last 3 months, we've done 32 to 35 billion, right? And that's a function of the fact that both global demand is strong, because the global economy is recovering, and also because India has worked on its competitiveness, investing in infrastructure, putting up manufacturing capacity, etc. So simply put, I think in terms of domestic growth, I'm fairly positive that it's literally like, if not now, when, right? I mean, if all the four components are firing, why should growth not come back? It'll be very surprising for me. Then there is an added layer when we're looking at, I think the stock markets will outperform the economy, because so in economics, there is a saying that things take longer than you expect, but when they happen faster than you expect, right? So,
Okay.
so when all these reforms happened, GST, RERA, DeMon, surprisingly for 2-3 years, there was not so much of a big shift from unorganized to organized. I mean, there was some anecdotally you were hearing, but if you see FY21 is when it happened with the violence. So as the graph shows, you had a year where the unlisted profits fell 30% odd, but the listed companies' profits went up 10% odd, right? So you had a massive shift where whether it's paints or textiles or pipes, I think all kinds of goods, the top 2, 3, 5 players who tend to be listed, they got a massive market share shift. And I think it obviously is happening because of multiple reasons. One is regulation, two is technology, and also access to funding. So with PSU banks and the risky NBFCs pulling back, I think a lot of the smaller and unorganized players have not been able to get funding, which is why you are seeing them not able to expand capacity, and the listed players obviously have access to funding. So due to multiple reasons, and it's also a global phenomenon that industries are consolidating. So overall, I think India to me is hopefully in a bit of sweet spot. Now, obviously, some unknown happened like Corona that we can't model, we can't expect that. But apart from all those four components, the last part is also that you have a financial system today, which is probably the cleanest we've seen again in the last 10-12 years. Because last 10 years, what has happened? Every 1 or 2 years, you got a credit shock, right? So first it was infrastructure, then it was commodities, then it was NBFCs. So now, if you see all the banks, they've provisioned or written off all the funny debt, and you have Maybe the retail side is still suffering because of the virus issue, but on the
Yeah.
corporate side, on the large corporate, on the mid corporate side, if you look at steel, if you look at any other metal sector, if you look at infrastructure, there are only clean guys left now, right? So you also have a financial system which can support literally any amount of growth that can happen, because the bank's books are clean, their capital ratios are healthy. Most of the incremental credit that is happening today is happening on the books of a HDFC Bank, ICICI Bank, Axis Bank, and not of a funny NBFC or a very small PSU bank. And you need to be concerned what they're doing. So, so yeah, I mean, overall, can't ask for anything more. But I think ultimately people have to spend money. That's the only thing left.
Yeah. You have to open the purse strings. Everybody has to.
Yeah, because finally, I think economy works on sentiments. We can talk about interest rates, we can talk about exports, this, that, but people finally have to spend money for the economy to fire.
True. So Manish, I mean, so then to summarize, you're saying two things, like, as we say, a watched pot never boils. So like we were watching out for, okay, what would demonetization do or GST do? It didn't happen.
Yeah.
And while we were busy with pandemic, the shift happened, right? So there has been a massive shift from unorganized to organized, unlisted to listed. Large has clearly become larger as they have gained market share. And admin, if you could pull up the slide number 3, then what I think top 200 companies listed on BSE, if you exclude banks and financial services, in the last 1 year, I mean, for year ending March 21, their earnings growth is up 29%, despite the fact that top line growth was negative 4%. So apparently, I mean, somewhere in between the top line and the bottom line, something has happened. So Manish, if you could elaborate on, how the margins at various levels would have improved, what happened there?
Sure. I think you should see this graph in two parts. The first half of FY21 was very different from the second half of FY21, which is why I think Q4 FY21, if you see on the left side, it's got a bit of different dynamics than the right side. So in the first half, it was all about cost control, right? Because when the lockdown started in March end and when was its most intense in the first wave around April, May, maybe June, companies were literally in a shock mode. A lot of companies knew that top line was going to drop. And luckily for us, the commodity prices also fell vertically, right? We saw oil actually go to zero almost.
Yeah.
So you had benefit of commodity cost, which fell vertically. All the advertising and promotion spending was slashed by a lot of the consumer companies, pharma companies. You had lot of employee salaries being revised, lot of employee salaries being variabilized. The fixed was cut and it was converted to variable. And a lot of companies actually benefited from work from home, right? I mean, your office overhead, your transportation overhead, especially for IT firms, which is a big part of the Nifty. Work from home actually turned out to be a boon because they could save a lot on operating expenses. So the first half, and I think what happened was for a lot of listed companies, while demand fell, it didn't fall to the extent they expected because the entire demand shifted to the listed firms in a sense. Because you were ordering online, you were ordering pharma, IT was doing okay because they were catering to Fortune 500 clients. So there was a lot of pain in the smaller companies, but a lot of the demand, whatever was there, went to the large guys. So the first half was more about cost. The second half, I think, was more about operating leverage because if you see, like in Q4, the sales grew 18%, right? Obviously of a small base because end of March, the second half of March 2020 was affected badly. So in Q4, you're still seeing that base. But the point is, sometimes incidentally, I was talking to a QSR company, and they were pre-COVID, they were working in 2 fixed shifts with same number of employees. And
Okay.
they said their margins improved because they variabilized employees to the extent that obviously in QSR also, your lunch and dinner time, 3 hours each, you get maximum demand. So they moved
Mhm.
to a system where, let's say, in late afternoon, they didn't need that many employees and they reduced the number of employees. So
Okay.
as I mean, it looks common sense. Why didn't you do it before? Right? I
Mhm.
mean, obviously you're trying to match resources to demand. You don't need a COVID to do this, right? Um, and they
But
were
it provided
frantic.
an excuse nonetheless
Yeah,
to
they were frank
justify
enough to
that you should
admit
remove.
that actually sometimes, all this kind of, you call it innovation or whatever, happens only when things are bad. And the other
Mhm.
part is, I think what they were saying was a bit correct as well, that employees don't accept it in a good time, right? I
Yes.
mean, if you tell an employee in a good time that I need only 10 hours per week, not 15 hours per week, maybe
Uh,
a lot of them will not accept it. But in a COVID time, obviously employees also started to accept it. So
correct. They were
I
more
think,
open, yeah.
yeah, so that whole you can call it ingenuity of management came into play. And
Mhm.
that remained even in the second half when sales actually came back. So part of it, obviously, so part of the cost saving went off, the commodity cost,
Mm.
the oil came back and all that. But a lot of these kind of productivity improvements that happened, maybe people thought even if people can come to office, let's keep 30% at home because it helps save costs. All that happened. So the
Mhm.
second half was more about this kind of operating leverage. And I think corporates in general are more fitter today. So even if,
Mhm.
let's say, we don't get a third wave and everyone can come to office,
Mm.
obviously IT companies are talking about 25-30% of workforce never
Yes.
coming back to office. Everyone will come in a rotation manner. So these kind of productivity improvements, I think, are here to stay.
That's good to know. So, Manish, why don't we discuss in greater detail about the factors responsible for this magical expansion in margins and corporate earnings? So, if we start with the first one, let's look at deleveraging, because I believe that has also been a key theme
Yeah.
in the last few quarters.
So I think deleveraging has two components. One is the interest cost itself and the level of debt, right? Because
Mm-hmm.
ultimately the interest cost you're paying is a product of these two. Now, again, I think, and this is a subjective opinion, I think India had a not so great monetary policy between 2015 to 2019. Where
Okay.
to my mind, we were too hawkish, right? I mean, if you look at the tenures of Raghuram Rajan and Udit Patel, I think they were too scared of inflation coming back. And on hindsight, that proved not to be very accurate, right? Because
So they kept interest rates very high,
very high,
which was
very high.
not,
So you
yeah,
had, if you remember, there were months when CPI was coming at 2.5-3%,
yes,
and
yes,
the Indian 10-year bond was still at 6.5, 7.5%. So
true.
virtually you were running real rates of 4%, which when anyway global growth was weak, India capex demand was weak, the corporates were struggling to pay debt when your top line is not growing and your real rates are so high, right?
Right.
So I think again, this may be because of the crisis or whatever. I think RBI has structurally turned to being more dovish, and which I think is the right policy, because clearly India is undergrowing potential, right? I mean, if you take a 5-year CAGR of car sales or bank credit, it is single digits, whereas our 20-year track record is 12 to 15%, right? So obviously you
Right.
are undergrowing potential. And
Mm-hmm.
in that environment, to be very hawkish on monetary policy, to my mind, was not a great thing. Now, obviously, I think RBI seems to be much more dovish. which means that interest rates are obviously lower. Right? So your home loan rate, for example, today, I'm sure is probably the lowest we've seen in 20,
Yeah.
25 years. And we are seeing, for example, in good NBFCs get 3-year funding at 5.5%, which was unheard of, right? So one is the interest cost itself has been a big boon for earnings. And second is courtesy, this whole, so it's a virtuous cycle which has been kicked off, that because earnings are good, cash flows are good, and then you're also reducing debt. So it's a classic example is steel, right? I mean, companies were at the verge of being bankrupt. So if you take Jindal Steel and Power, for example, used to have 38,000 crore of debt about a year back. One good year is down to 20,000 odd, right? If you look at Authority of India, they've reduced 30,000 crore of debt in 1 year from 55,000 to about 30,000 odd. So think of what it does to the P&L, that on 55,000 crores, you were paying, let's say 9%, and now on 30,000, you're paying 7%, right? A massive fall in the interest cost. So clearly deleveraging and I think more importantly, the interest rate. And I feel that even if growth comes back a bit, inflation goes up a bit, I don't think we will see any big rise in interest rates.
So you would think that interest rates would remain in a narrow band going forward for next couple of years?
So I'm actually a very big bull on long-term Indian bonds, actually, because I think that inflation in India, the more it remains in this band of 2 to 6%, which is what. So I think about it like this: that ultimately your interest rate is a function of inflation plus real rate, right? Now that real rate is a kind of risk premium, that if your economy is very volatile in terms of inflation or current account deficit, investors, it's like a leverage stock, we give low P, and a good balance sheet, we give high price to earning multiple. It's like that. So investors don't like economies where CPI is 2% 1 year, goes to 11%, comes back to 4%, right? Investors like to see, the bond investors basically, they like economies where, and that happens in developed markets like Germany or US, where inflation is in a very tight band of 3-4%, right? From 0 to 4, that's the range, right? So the more India spends time in this 2 to 6% without seeing macro instability of CPI, like 2011 to 13, we saw CPI go to 11-12%. If that doesn't happen and we see inflation in this 2 to 6% band, this real rate to my mind will come down, right? Because it is effectively a price to earning multiple types. The more you behave yourself for 10 years, your price to earning and multiple improve.
Yeah,
right?
The more volatile you are, the risk premium needs to go up to
so
that.
Since 2014, I think India has behaved pretty well on inflation front. We've not broken this band. And which is why I think you are seeing real rates come down. So as I said, 2015 to 2020, we had real rates of 3 to 4%. You can say today it's almost zero because CPI is 5.5, 10-year bond is 6.2. But I think that these real rates, like if our long-term inflation is actually 4 as targeted by RBI, and even if you assume real rate of maybe 1%, I think long-term bonds in India across cycles should slowly keep coming down to maybe 5.25%. And the other part why I'm bullish on bonds is if you see the inflation dynamics, in a slightly poor country, not slightly, maybe a fairly poor country like India, our inflation, unlike US, is not driven by wages. It's driven by commodities like food, energy, maybe real estate, right? I think all three, frankly, I don't see any big price increase on a long-term basis in all this, because see, your energy is seeing massive technology shift from fossil to electric vehicle and renewable, right? So it's unlikely that crude sustainably will go above 70, 75. I mean, in a spike it may, if there's a war somewhere or whatever, but if I think Saudi Arabia itself been on record saying we don't want more than 80, right? Because they know that then people will
That's
shift
a
to.
sweet spot, and
Yeah.
they're
So I'm saying if in 3 years down the line, if you're going to see crude at 75, virtually there's zero inflation in energy, right? Even in food, if you see our demographics, our population growth is coming down. Our rice and wheat production is already in excess of what we need, which is why you see the go downs of Food Corporation of India being overstuffed.
Mhm.
So food, I think it's just about policy. Government decides what kind of inflation. Otherwise, there's no need for any inflation there. There is enough stuff. And even real estate, I think when we see work from home, when we see what are the rental yields right now, I do expect real estate will do well in terms of transactions, in terms of volumes, but I don't think that there is a case to be made. I see enough supply in most cities, right? I mean, Bombay, we've not seen real estate prices go up for last 5, 6 years, and still there is a lot of inventory. And with work from home, the office space, retail space is obviously in excess, maybe, right? So I don't see inflation really going out of hand.
So that should remain in control. So,
Yeah,
okay, so coming back to earnings growth, another factor I would say is leveraging technology, which all
yeah.
companies, like you said, have used made full use of. So digitization and penetration level of mobile phones, access to Wi-Fi, they've all played an important role. And so why don't you discuss in greater detail and share some examples at how have companies used technology to their advantage, and going forward, is this leverage sustainable?
So actually, this is something I'm quite passionate about. I actually used to run a technology firm at some point. So I like this space. So I think what is happening, and again, this is a replica of what happened in US from 2010 to 20. So if you see 2010 to 20, US, the corporate profit to GDP went up to an all-time high and still there. And I think the
Mhm.
reason is basically that, as I said, that I think the stock market will do better than the economy because essentially technology is allowing you to collect a lot of fragmented profit pools and play it on the stock market, right? So if you think about Zomato, what is it? There's probably millions of restaurants in India or food stalls. Now, I couldn't buy any of these individual ones, right? But if
Mhm.
Zomato is getting from them, then I get to play one single consolidated entity, which is getting a cut out of them. Similarly, if
Mhm.
you look at Make My Trip, right? There's so many hotels, 3 star, 2 star, which as a listed person, I can't participate in. But if
Mhm.
Make My Trip or Ease My Trip, whatever, they are able to get a profit cut from each of these hotels and
Mhm.
airlines and taxi services, then I get to play a consolidation of that profit pool, right? Um,
Yeah.
so one is that very fragmented profit pools are coming together because of technology, right? And this is the creamiest part. This is the highest return on equity part because these guys don't have any capex. They're just getting paid for the technology or the platform.
Mhm.
The
Yeah.
second part is where the massive profit pool shifts in the industry. So, for example, if you look at banks, now typically what used to happen was if you go to a state like Tamil Nadu, you had a lot of regional banks who were doing well because the customers needed a branch to go to. They needed a lot of customization. Um,
Mhm.
but when like you and me, I think hardly go to a branch, right? Because technology today for us, banking is an app basically, right? Now,
Mhm.
when banking is an app, then what advantage can a small bank in Tamil Nadu have versus a HDFC Bank or ICICI Bank, right? Which is why
Yeah.
you're seeing that both in terms of liability growth and in terms of advance retail advances growth, HDFC and ICICI are outperforming a lot of these regional banks or state-specific banks, right? So technology is obviously accelerating that kind of consolidation as well. The third part is also quite interesting that because technology can move so fast, you are seeing that a lot of technology go into adjacent areas very quickly and try to conquer that. So think about healthcare today. Now, I'm not talking of hospital. I'm talking of things like diagnostics, pharmacy, doctor
Mm-hmm.
consultation.
Right.
It's interesting what is happening. So if you think about it, earlier all these segments were separate, right? First of all, most of the pharmacies were mom and pop shops, unorganized, right?
Mm-hmm.
Diagnostics also with some large players like Path Labs and Metropolis. Um, and we didn't have online. This was maybe
Mm-hmm.
about even 5-7 years back. This was the situation. So
Right.
today, if you see Apollo hospitals, their app Apollo 24/7. So they have an offline pharmacy which they've built over last 10-15 years. Now
Mm.
they have an online pharmacy. They have online doctor consultation platform, and they're getting into diagnostics, right? So
Mm.
essentially, there are four businesses now versus probably nothing 10-15 years back,
Mm.
nothing apart from offline pharmacy 5 years back.
Correct.
If you see
So
what
because of
pharmacy,
technology, they've been able
yeah,
to build
because
something
because
platform, leverage
so
that.
so one is bolting online pharmacy to offline is very easy. Then
Hmm.
since you've got the customer, see, it's all about customer acquisition, right?
That-
Now, if I have a customer who's coming to me for medicine, it's quite likely that he will need a test, right? So you're offering that online. Today, customers also used to ordering diagnostic test online, right? So anyway, since you're coming to the app to buy medicine, is obviously synergistic maybe to offer a diagnostic test. So if you think
Hmm.
about what PharmEasy has done, so they came from a background of online pharmacy, right?
Yeah.
And then from online pharmacy, they bought Thyrocare, which is a offline diagnostic lab,
Yes.
right? So that this is the thing about what Amazon has done. So when Amazon, let's say you bought Amazon stock in 2004,
Hmm.
there was no Amazon Web Services then, which is actually the most profitable business at this point, right?
Right.
So from just being an online e-commerce site, they went into Amazon Web Services, which is more about IT infrastructure.
Right.
So the point is that why we think a lot of these technology platforms will grow and become big part of the market is you just can't see them from the lens of saying they are, let's say, in diagnostics and therefore they will remain in diagnostics. Because with technology, if it's an app,
Hmm.
I think a lot of these platforms will have a lot of M&A. They will have a lot of going into adjacent categories, and we will finally see some very large companies emerge.
And one can participate as and when they are listed.
Yeah,
I
and,
mean,
and a lot of them
companies
are
they are
private
listed.
equity funded, which means that they will get listed. Even
Hmm.
from, I think, even from a stock option perspective, because you obviously need to motivate your employees.
Employer.
You would prefer to be listed, right? Because everyone
Hmm.
likes
Yeah.
to see stock option wealth.
Absolutely. So, Manish, that's very interesting. Another facet we could look at is government regulation. I mean, we've had various policies like insolvency and bankruptcy code, RERA for real estate sector, GST, labor reforms, Jan Dhan, direct benefit transfer, etc. And now, PLI, uh, China plus one, what everybody's talking about. So if you could, give us a sense that how that would have added to the earnings trajectory as far as, corporate sector goes.
Sure. So again, it's all about profit pools converging to certain big players. So, for example, if you look at Mumbai real estate, right? I mean, RERA was such a big trigger point that uh, now Mumbai real estate obviously been a very murky, kind of very funny business in a sense. And whatever brands we used to have, the Hiranandanis and the Rahejas, these were all
Yeah,
founded, 40, 50 years back. But if you
yeah.
think about it, which are the top two Mumbai real estate players today? It is Lodha and Godrej Properties,
Hmm.
right? So you had a lot of established players more than 40, 50 years back, which have lost massively to someone who's more organized, more professionalized, listed, with all
Hmm.
the
Hmm.
systems and processes, etc.
Right.
I think that even if you look at fairly rudimentary kind of goods like pipes or paints, I think
Hmm.
a lot of, and these have been very good performing stock sectors in a sense, right? And the reason being that even in economic downturn, let's say in a COVID year like last year, um, Supreme and Astral, they still grew positive.
Hmm.
Whereas it is obvious that a lot of the smaller pipe companies which were not listed may have dropped 30-40% in turnover because the first half was virtually empty, right?
So
Um,
basically, these Supreme, etc., they gain market share because of the smaller players now had to pay GST.
One is GST, two is working capital. How does like I was talking to the CFO of Astral, for example, and he was saying that a lot of these smaller pipe companies have offered himself to sell out to Astral because um, that PSU bank thing, right? I mean, a lot of the smaller guys, they used to get
Hmm.
working capital from PSU
Understood.
banks. But after that NBFC crisis, when the government um, I think government is obviously in a benign neglect of PSU Bank, right? They virtually want their market share to go to zero, but they don't want to say it, right?
Hmm.
So if you see the growth of a PNB or BOB, their advance growth is virtually zero, right? So if that funding is stopped, then obviously a lot of these small players are in stress. They can't grow without working capital and stuff, and also about GST and stuff. So yeah, I mean, you are seeing those kind of things happen.
And on the PLI, how do you see that benefiting Indian companies? And would we be able to leverage this China plus one strategy, which most global players are looking at now?
So again, this I think along with technology is probably the two mega trends that we are seeing in the economy
Mhm.
today. And this is nothing new. So as this graph shows, Vietnam has executed this brilliantly. So Vietnam has a population of 10 crores, right, which is 1/12 or 1/13 of India.
Yeah.
And over last 10 years back, their exports were 1/3 of India. Today they are marginally ahead. And the
Mm.
only reason that happened was they just took, I think, two big sectors, electronics and textile. They took whatever came from China. And obviously,
Sure.
with that low base and the fact that along with Bangladesh, Vietnam, they have a lot of friendly policies from US and EU because they're seen as least developed countries.
Mhm.
So they had these kind of benefits. And I think India was obviously missed the boat in a sense, in especially electronic manufacturing, right? Because we saw all the phones, the boom in smartphones and all 10, 15 years back, but we didn't do anything about it. But obviously now I think there is recognition that we can't run a negative trade deficit in electronics. There is recognition that China, both from a cost perspective, because Chinese labor is more expensive, their environmental compliance is more expensive, the currency is more expensive, right? I mean, over last maybe 5 years, Indian currency would have depreciated 20-30% against yuan, right? I mean, that also gives you a lot of benefit. Um, and also now the geopolitical angle, right? I mean, given the way relations are between US and China,
Yeah.
obviously India and US seem to be coming together a lot more. Um, so the base of Chinese manufacturing is so high that
Mm.
we can, I think, grow in a lot of these segments like chemicals, electronic manufacturing, 15-20% for at least 10 years, very easily without.
Basically, they have such a large market share that there is always
Yeah,
space for others to eat into that and grow their market share, and that itself would provide for a good growth rate.
yeah. So, for example, in ACs, their biggest player, I think, is about 10x of whole Indian consumption, is the biggest Chinese
Mm.
manufacturer, right? So clearly, and that's true of a lot of segments.
Yeah.
So clearly, you have geopolitics, you have cost competitiveness, and I think overall there is central government focus. Good news is also anecdotally you're starting to hear that state governments are competing to get some of these MNCs who for PLI schemes wanted to come to India. You get to hear that MP and Telangana are fighting to give them more and more incentives to set up plants in their respective states,
Mm.
which is obviously a good thing. So I think that given the success of chemicals, nascent success in electronic manufacturing, I think
Sure.
textiles, for example, I think India has massively lost market share in global trade, and I think there is no reason why we can't get
Mm.
back that
Get
market share,
back.
both on the yarn side as well as on the garmenting side. Things like auto ancillaries, whatever. I think India obviously good in engineering, right? So
Sure. Yeah.
I don't think semiconductors is where we will go in next 5-10 years because that's too capital
Mm.
intensive. But
Mm.
wherever there is a bit of labor and engineering involved, which was, I think, the recipe for success in chemicals,
That's the
I
sweet
think
spot for us.
that's the
Mm.
sweet spot for us. Maybe our
Mm.
infra is not great. So pure labor till now did not see traction. But the good part is today what has happened is yeah, you might have read it that Bangladesh GDP per capita is more than India right now.
Yes.
It's a bit of a wake up call.
Let's
Um,
hope.
but but
Yeah.
but the
Mm.
silver lining for that is hopefully a lot of these export incentives these countries used to get because they were very poor now go away, right? So they also now have
Mm.
to compete with India on a level playing field.
Sure.
So I am quite hopeful that if we get a decade of what Vietnam had last 10 years,
Mm.
and the good part is you're seeing the numbers now, right? As I said, after
Yeah. So
a
you're
decade,
already seeing
exports,
beginnings of that.
yeah, our
Mm.
exports have started picking up 30-35 billion now.
Mm.
Almost a vertical increase from 25-27 what we were doing 3-4 months
Mm.
back.
Yeah.
And then I think if India pulls this off, it will become a game changer actually. Because even from a society perspective, frankly, while technology is a good part, but technology can benefit only the top 5-10% of India, right?
Right.
This part can actually benefit 40-50% of India, right? So whoever is semi-skilled labor,
Yeah.
carpenters, plumbers, whatever, this really hits the ground in terms of employment, right?
True. So
Um,
yeah, true. So let's hope for the best that we win on all fronts on account of this, and the government plays its part, and the corporate sector plays its part, and we'll all benefit, I guess, over the next few years if we are able to replicate what Vietnam did. So great. So okay, Manish, coming back to corporate earnings growth, we have discussed, the factors which have affected negatively, positively over the last 2 decades. And every time in the last 10 years, we entered every new financial year with a lot of expectations. And this time now, for a long time, after a long time, last 3 quarters, we've actually seen earnings upgrades rather than downgrades. So, what is the medium term outlook in the current context, and how far you think that corporate earnings growth will continue to drive the stock markets?
So if you think about it again, from a very long-term cycle perspective, I think at least in our careers, we've seen two cycles now. So FY 2000 to FY 2008, Sensex earnings grew at 26% CAGR, which was obviously fairly in excess of nominal GDP, which was that time growing
Hmm.
slightly higher because inflation was higher, so maybe 14-15%.
Hmm.
Uh, and then we had a long winter of 10-11 years where Nifty earnings have grown at 5-7%, whatever, negligible levels. And which
Yeah.
was, again, much below the nominal GDP of, let's say, 11-12%. Uh,
Right.
FY 21 to that extent, a watershed year maybe because hopefully the cycle has turned. The nominal GDP hardly grew because of the COVID crisis, but Nifty earnings grew at 12-14%. So in a sense, we've seen corporate profit to GDP again at least bottom out and hopefully move up. Now,
Hmm.
I think the next 2 years, to my mind, when we see on a bottom-up basis, seem quite highly probable, or maybe certain is too strong a word. And the reason for that is a lot of it is actually mean reversion, where you are
Hmm.
seeing fairly concrete signs, right? So I think if you see, we are basically talking of about 50 to 60% growth in corporate earning FY 21 to FY 23. Lot of it is about banks credit cost coming back to the mean, commodity stocks being priced on reasonable prices, not even the prices we are seeing today. So
Hmm.
just as an example, when we look at steel stocks,
Right.
today HR coil is about 62-65,000 per ton.
Hmm.
But that's not the price that is being projected for next 1 or 2 years. The price is more to the order of 52-53,000 per ton. So it's
Right.
not like the supernormal rise. So it used to be around 40,000 per ton maybe a year back, or
Hmm.
pre-COVID. So this huge rise we've seen, we are not even saying that that will sustain. Similarly, if you see, let's say, aluminum stock, no one is assuming that aluminum will be 2,500. Everyone is 2,100, 2,200.
Hmm.
So I'm saying that there is a fair amount of buffer built in, maybe because last 10 years have been so bad, even the analysts and fund managers now don't
They're
want to
more
make,
cautious.
yeah, we're very cautious about what we are projecting. Uh,
Hmm.
the question is maybe longer term, will we get a 6-7 year cycle like we saw in 2000 to 2007?
Hmm.
Um, the good part is actually because interest rates are lower, we don't even need 25%, right? I mean,
Hmm.
so if you look at, let's say, corporate profit to GDP, it has fallen a lot. So even if it doubles, basically, then our corporate profit grow at twice the nominal GDP, which will be 20%, which will obviously
Hmm.
be fab. So yeah, I'm quite hopeful that we can see a medium-term earning cycle, also layered by the fact that even if GDP doesn't grow um, at what we expect, maybe it's 1% lower or whatever,
Hmm.
the
Hmm.
fact that consolidation is happening, right? That can
Yeah.
give you some buffer as well, because so what I'm saying is, if I combine listed and unlisted firms, if
Hmm.
they grow corporate profits at, let's say, 14% or 15%, I am sure the listed companies will go at 20%,
Okay.
because of this whole shift from unorganized or smaller to larger. Um, and
Hmm.
the final element to this, I think, is the composition of market will change, right? I mean, you will see a lot of these new age business models, the China plus one companies come into the market. We've seen a flurry of them. And I
Right.
think this also happens in fits and starts, right? So I do expect some kind of correction in this whole IPO mania that's happening,
Hmm.
because still are getting funded too easily. So you're seeing 100 times the demand, all that will go away with one correction. But
Okay.
from a medium-term perspective,
Hmm.
I think a lot of these internet platforms, gaming, aggregators, a lot of these companies will get listed. The SaaS companies will get listed, um, and those are obviously higher growth companies, right? So I think some part of it. So today, for example, 5 years back, chemical sector profits were negligible part of the market. Now,
Hmm.
when chemical profits grow, they can start making a
Become
difference to BSE 200 growth or BSE 500 growth, right? So
okay.
I think that the creative destruction, as we call it, where in the mature sectors go out, so some of the power utilities or cement or two-wheelers, which are very mature sectors,
Hmm.
their contribution to the indices might go down.
Yeah.
And a Policy Bazaar, Zomato, Paytm, whatever, these kind of firms. Not, I'm not saying these are good stocks. I just want to make a difference
They were,
that we like some of them, we may not like all of them. But the
correct.
point I'm trying to make is that these are in general faster growth companies, which will become a bigger part of the market.
Of the whole pie.
Yeah.
So, Manish, this graph on your screen clearly shows the cyclicality of, earnings as a percentage to GDP.
Yeah.
And one can clearly say in the last 3 decades that we are at the bottom, and it's beginning to now turn around, and hopefully we'll have the next big cycle ahead of us. So
Yeah.
long way to go.
Yeah, so if you see this graph, what we're saying is even if that 2% doesn't go back to 7%, even if it goes back to
Uh, uh,
4%, so roughly put, if nominal GDP grows at 10, 11%, which means that
hmm,
we will double nominal GDP in 6 to 7 years.
yeah.
And in these 6 to 7 years, maybe starting from FY21, when the bottom was
Hmm,
made, uh,
hmm,
if this 2% goes to 4%, which is doubling again, so basically
yes.
profits will grow 4x in 6 to 7 years, which
Hmm.
is obviously a good market to have then.
Gives
Now,
like a 15 to 18 to 20% growth, depending on
yeah,
which segment we are
20,
looking at
20%.
in terms
Yeah,
of.
so you have a buffer that we're not saying that needs to go back to 7%.
Hmm.
Uh, mm, yeah,
As long
so
as it goes up to like 4.5
yeah,
from 1.5 to where we are. So Manish, we are running out of time. So do you have extra 10-15 minutes so we can extend the session? Because
sure.
it's nearly 12. So we'll have a couple more topics we wanted to cover, and then we'll go for Q&A. Okay.
Sure.
Okay. So Manish, which sectors now we discussed will contribute, you think, to the earnings going forward? I mean, you've hinted at 2, 3, but broadly, uh, as the majority of the earnings growth, where do you think it'll come from?
So in terms of size and typically what has not worked will obviously revert to mean. So I think from a bottom-up analysis, banks and materials are basically largely commodities like steel.
Hmm.
Cement is a domestic commodity, steel is a global commodity. So roughly, I think more than 50% of earnings growth from FY21 to FY23
Yeah.
will come from these two large sectors. But I just want to underscore that when we say 36% is coming from financial, it's not that we are expecting credit growth to go to 20% or anything grand to happen. It is just
Hmm.
that typically, if you see the large banks which went through a corporate lending cycle, obviously suffered a lot from 2015 to 2020. Um, and then, unfortunately, a bit of a retail down cycle because of Corona. So all we are saying is, if let's say the 20-year average is credit cost of 1%,
Hmm.
we are just saying that what is 2.5, 3% now comes back to 1.25, 1.5%. We are not even going back to the 20-year average. And since banks are leveraged entities, this kind of delta creates a lot of earning growth because effectively your pre-provision profit is around, let's say, 3-4% of assets. So
Mm.
credit cost instead of 2.5 becomes, let's say, 1.25 or 1.5. It obviously creates a massive impact on earnings. So that is the point. Also, as I mentioned, if you look at sectors like consumer discretionary, whether you take car sales or retailing, clearly between COVID and even before that, for 2, 3 years
Mm.
before that, also the economy was soft. And the good part, I think, is that the balance sheet, I think everyone has benefited, at least as I said, the top 15-20% households, they've benefited from the
Mm.
fact that stock market is up, your bank deposits have grown. So the wealth has not suffered that much.
There is a
And
wealth
also,
effect there, which will prompt
yeah,
people to
there is
consume
a
these.
fairly big wealth effect to my mind versus expecting. I think March
Mm.
2020, everyone went into belt tightening mode,
Right.
saying that you don't know what's going to happen. And you're
Mm.
coming out of a crisis realizing that whatever stocks I owned are up 25-30%.
Oh.
Uh, my bank deposits have accumulated wealth. Real estate has not fallen, it
Mm.
may not have improved, but
Improving, yeah. I mean,
gold also
little bit.
went flat. So typically of those four big asset classes, real estate, gold, fixed income, and stocks, everything is either flat or up. So it's not like you've lost wealth, right? And you've saved because
Mm.
you've not spent on discretionary stuff.
Mm. Mm.
So, and large sectors like IT now doing well. I mean, that
Mm.
in
Mm.
real estate in Bangalore and places like that quite a lot. Um, so I think that the certainty on this FY, at least for next 2 years, is just reversion to mean. I think beyond that, you need the economy to fire.
I
I
think
think
the
FY
time
20,
will tell. Mm.
yeah, because beyond that, then bank credit needs to go 12-15%. Car sales needs to grow 12-15%. I think that is a tough one. Uh, Also, the second part is that a lot of goods also perish, right? I mean, a car which is 7 years old, you may want to change because obviously not
Mm.
as functional as it was. So if you look at commercial vehicles, for example, right? Um, the analyst estimates broadly are that by FY24, uh, the number of medium and heavy commercial vehicles will be same as FY19, right? So we are
Mm. Mm.
saying that no capacity addition in 5 years. It's just
Yeah.
replacement. Typically, the life of a commercial vehicle, heavy commercial vehicle, is 5-6 years, right?
Mm. Mm.
So I see that a lot of these estimates seem fairly conservative. That effectively what we are saying is from FY19 to FY24, the fleet of commercial vehicles on the road will not increase. It's just that
Sure.
whatever is scrapped will be replaced, right? So if there's any kind of growth, effectively the numbers should actually be higher. So
Mm. Mm.
my point being that while on price to earning multiples, you look at a lot of these cyclical sectors, they look expensive. But obviously, when you look at the assumptions that are being made, they're not very aggressive.
So at a granular level, you think that there is a lot more certainty when you break it up sector by sector
Yeah.
and stock by stock, that the sum total is what will get delivered. And I think that is what, as investors, we are concerned with. That is your job to pick up the sectors and the stocks, within that, which are likely to deliver with what kind of certainty. So we
I just
should
want to
leave
add
that to
one
you.
part that
Mhm.
if I'm sounding that stock markets are a place where we get monthly 1%, this is not. So
Yeah,
while
of course.
earning certainty is there,
Hmm.
liquidity, global shocks, and also
All
the
of
fact
those, yes.
that globally markets are elevated because US kind of market has been doing well for 10 years, right?
Hmm.
So,
Hmm.
so there it may happen that we will get a lot of shocks in between. So when we are projecting this medium term picture, I think we have to be clear that
Hmm.
investors should not look at equities that everything will happen, very smoothly. We will get some
Very
shocks.
smoothly, yeah. So in terms of risk factors, Manish, like you said, for stock markets, of course, there could be various risk factors like global liquidity or interest rates going up. But do you also see any risk factor which would move the earnings from their projected trajectory, what we are saying? Any risk factor there?
The standard thing is, of course, a third wave. Now, the risk reward, I think, is in favor of it not having, in the sense that when you see servo prevalence studies now, India, unfortunate fallout of having a torrid second wave is that almost 2/3 of our population have antibodies now. But you never know. But the problem is that if there is a new variant apart from this Delta, we didn't see Delta
Yeah.
coming. So maybe if there is a big new variant where the vaccines don't work, that obviously is something which is a challenge. Directly impacting earnings is difficult. I worry a bit about politics, about the UP election next year. Because obviously if the ruling party doesn't win it, we know that the alternative is a big fragmented coalition which investors will not like, and which
Yeah.
may indirectly play on earnings from a long cycle perspective, not for the next 1 or 2 years. Uh, there are obviously standard risks for India that if oil goes to 100 and all, but I see them as a very low probability risk at this point.
Okay. So more or less at a granular level, next 2 years, I mean, we don't see at least any kind of major shock which could affect corporate earnings. I think that's good news. So Manish, let's look at the Q&A section. So there is a question there which someone is asking that what is your view on the telecom sector? What's happening there?
So we have I think it's public information. We have a big holding in Bharti. But there is a bit of difference. My fund managers are more bullish than I am. I'm also bullish, but not massively bullish as them. So clearly, it is a sector which went through a torrid phase. Jio unleashed a pricing war, which threw off the weak guys. And I think all of us read the newspapers that Vodafone is in a big soup. Question is, will there be... So the way we look at Bharti is very simply that if there is some kind of bailout of Vodafone, we will make normal returns. If Vodafone... So when I say Vodafone fails, not that overnight it will close down, but it is kind of virtually failing on the ground, where month by month its market share goes down, right? Because all the subscribers...
And Bharti and Jio are gaining at their expense, basically.
Yeah. So if nothing changes on the Vodafone side, we think that it can give very, very healthy returns. And as of now, well, again, you see ups and downs. I think in a sense, the stock is compounding where you see a lot of ups and downs. But as month by month, as Vodafone becomes weaker, we think that Bharti will gain and the stock will do well. The only caveat or the thing is, it's not a high growth stock, right? The unfortunate part of this sector is this sector has already reached 100 crore people. So it's a very, very penetrated sector. So if you think about revenues of the sector as number of people into ARPU we think will go up because of this consolidation and weak players going out. But unfortunate part
is average rate per user.
Average rate per user, right? So that part will do well. But because it is penetrated so much, number of users can't go up because they already...
At very high penetration
virtually
level.
has it. Yeah. So it is a stock where we will need to sell at a point, because beyond a certain point, there is not growth. So whenever this profitability comes back, it's not a compounding stock, let me put it that way. But at this point, it's a good value stock.
Okay, so Manish, let's look at the next question. Can the large continue to become larger, like you said earlier, or is there some disruption waiting to happen?
No, because of disruption, large will become larger. Because what is happening is whoever is able to master that turn. So it's quite interesting that if you think about the stocks that have done well recently, and benchmark it to within that sector, which is the best perceived player on the technology side, I think there's a lot of overlap, right? So whether it is in financial, ICICI Bank and Bajaj Finance, in healthcare, it's Apollo Hospitals. So all these companies, now see the perception, right? No one scientifically can say that the technology of a Bajaj Finance is better than a lot of other NBFCs, but there is a widespread perception that these are the best technology players within their sector. So when we say disruption, it is not just that a new player coming and taking market share, like a pharmacy coming and taking market share in pharmacy is one thing, but it's also about, as I said, a lot of different business segments coming together on one technology platform, a lot of fragmented profit pools of travel agents or restaurants getting merged into one player. So because of disruption, I think we will create some large businesses.
Manish, I think there's some
Rajul,
connection problem with Rajul, and this
Yeah.
brings us actually to the end of our session. Thank you so much for taking out time. It's been very, very informative and educative. Thank you very much.
Thanks, everyone. Thanks for your time.